Hi, welcome to this professional options trading course, lesson 1, which is the basics of options trading. I'm Adam Koo, and together with me is Bang Pham Van, who is an options specialist. He's been trading for the last 12 years. In fact, he's the one managing my corporate account, trading options and getting double-digit returns, right, every single year. So in this lesson, you're going to learn about the basics about what options are all about and how you can really use it to magnify your returns and minimize your risk in the market. So let's begin. So why learn about options? Because options are a very powerful tool used by both long-term investors as well as short-term traders. And if you seriously want to magnify your returns, you have to learn about how options can help you to do that as well. So as an investor, how can you use options? Well, the first thing is investors use options to hedge their investment portfolio. So in other words, options are kind of like insurance policies where you buy insurance, you pay a premium so that if the market goes down, you don't care because you've insured your portfolio. For example, let's imagine you've bought a lot of stocks of companies, right? And it's worth, say, $1 million. And you know that in the long run, it's going to go up. But in the short term, you're afraid of a recession. You're afraid that the bear market is going to come and your $1 million is going to drop to $500,000. So what you do is you buy a put option that insures your portfolio at $1 million. So once you buy that insurance put option, what happens is even if the market crashes, your portfolio is still worth $1 million. Yeah, isn't that cool? Right? So with options, you can hedge your investments and you don't care if the market collapses because you have protected your capital. And you learn more about this later on in the lesson on protective puts. Number 2, options can be used to generate additional income for an investment portfolio. So normally as a long-term investor, you buy stocks. How do you make money? Well, number 1 is you collect dividends every year. And dividends are usually about 2 to 3% a year, which is pretty boring. And you hope the stock will go up in price. Okay. Now, you can use options to generate additional income. We call it selling covered calls. And again, you're going to learn this in the next few lessons. And with selling covered calls, even if the stocks you buy don't go up, they go sideways for 10 years, right? Besides collecting dividends, you are able to collect an additional 20 to 30% return by collecting premiums by selling call options on your stock. If you think, what the heck does that mean, right? Coming soon, hold on, you're going to learn it in this program. So basically, with options, even if the stocks you buy don't go up, they go sideways for years, you can get an additional 20 to 30% return by getting premium by selling options, right? The third way we can use options as investors is to buy stocks at a discount or even for free, right? And later I'll share with you who does this in a really, really big way. So for example, let's imagine Coca-Cola is selling at $60 and you say, you know what? I don't want to pay $60. I want to pay $50. With put options, you can actually collect premiums and buy at a big discount or even sometimes paying nothing to buy Coca-Cola stock. You say, is that possible? Absolutely. You're going to learn this under selling cash secured puts. So all these are fancy strategies that we use in options to achieve all these things. Now, how about as a trader? So if you are a short-term day trader or swing trader, you use options in a very different way. You use options as a way to replace buying the stock itself. I know for many of my American friends, you can't use CFDs to leverage in the market. So one good way is to use options. With options, you require much less capital compared to buying the actual stock. Like for many of my students, they say, you know what, one share of Apple costs $200. You know, I don't have $200, right? I want to invest in Google, but it's like $1,000, or Amazon is $2,000, right? It's too expensive for me to buy that stock. But with options, you just have to pay, for example, for Apple, $10 to control the $200 stock. So with little money, you can control a big asset, and options allow you to do that. So what that does is it allows you to magnify your returns and minimize your risk. Because if you buy Apple at $200 and Apple goes bankrupt, goes to zero, you lose $200. But when you buy, for example, a call option, which you're going to learn later on, you only pay $10 to control the $200, which means if the price goes up, you get the same benefit of holding the stock. But if the stock goes down, it goes to zero, you don't lose $200. You only lose $10, right? So yeah, options actually can help you to minimize risk and maximize returns if you know how to use it the right way. The next thing is, with options, it's kind of like a Swiss Army knife over here, right? When you buy stocks, you either make money going up or make money going down, by going long or going short. With options, you can actually create different scenarios where you can make money whether the market goes up, market goes down, or market goes sideways for months or years. All right, and that is the power of options. So with that, let's learn how to use options. But before that, I'd like to ask you a question. Do you know who is the biggest option trader in the world? Who's the guy who trades the biggest quantity of options in the world? Make a guess, and I'm going to reveal it on the next page. All right, have you made your guess? Do you know who the world's biggest options trader is? And the answer is, drum roll please. The answer is Warren Buffett. That's right, the big man himself, the world's greatest investor himself. You know, many people think that, hey, Buffett made all his money by investing in stocks like Coca-Cola, American Express, right? So people buy all these stocks and they wonder, how come I'm not making the same returns he's making? That's because they don't understand, besides buying stocks and holding the stocks for years, he uses options to magnify his returns and minimize his costs. So how does he use options? There are many ways, but I'm going to share with you 2 ways that he uses it right now. The first thing that Buffett does is he sells put options on stocks that he wants to acquire at lower prices. Now again, later on I'll explain in detail what put options are. So if you don't really understand right now, it's okay, but I'm giving you a general idea, right? So for example, he wants to buy Coca-Cola shares at $50. Okay, or rather, right now Coca-Cola is selling at $50. And Warren Buffett wants to buy it as cheap as possible, right? Because he knows in the long run, the shares will go up, but he wants to buy it at a discount. So instead of buying the shares at $50, what does he do? He will sell put options at a $49 strike price. Now again, what's a put option? It's an insurance contract. So he sells insurance to someone who buys the insurance on Coca-Cola. So in other words, what Buffett is doing is he's saying to that person, if Coca-Cola drops to $49 or lower, no worries, I'll buy it from you at $49. He makes that insurance to that person. Now in return, that person, whoever bought the insurance contract, pays Buffett a premium of $1. That make sense? So Buffett sells a put option, collects $1 in premium. And Warren Buffett, by collecting the premium, is obligated to buy Coca-Cola shares at $49, which he wants to do anyway. So even if Coke drops to $45, Buffett is obligated to buy it at $49 because of the insurance contract. So what are the different scenarios? Scenario number 1 is Coca-Cola does not go down to $49, right? It stays at $50 or goes up. Now in that scenario, what happens? Buffett collects $1 for free. So he collects free premiums and he keeps selling put options. So if Coke keeps going up, he sells put options, he collects $1. Eventually, he will get, maybe even $40 or $50 and gets to buy Coke for free, right? Because of collecting all these premiums along the way. So that's the first scenario. Second scenario is Coca-Cola indeed goes down to $49 or $47 or lower. In that case, what happens? Buffett is now obligated to buy Coca-Cola at $49 because he sold the insurance policy, which he wants to do anyway. So he buys it at $49, right? So in other words, either way, he wins. It's a win-win situation. It's a no-risk situation. Sounds too good to be true, but that's how options work if you know how to use it the right way, and that's how Buffett uses it. So an example is when Buffett wanted to buy Coca-Cola shares, he kept selling put options below the actual price. And in the end, he collected $7.8 million in cash by selling put options. And he bought Coca-Cola shares eventually at a huge discount. So you got to learn how to do this as well as a small-time investor. All right. The second thing he did was he sold put options on the S&P 500 index. Because Buffett knows that the S&P 500 index, an index will always go up in the long run. It may go down in the short term because of volatility, but in the long run it always goes up. So what does Buffett do? Buffett, during the financial crisis of 2018, sorry, not 2018, typo, 2008, right? He sold put options on the S&P 500 index. In other words, again, he sells insurance to tell people, hey, if the index drops below a certain level, I will buy the index, which he wants to do anyway because he knows that it will go up in the long run because he's a long-term investor. But in the meantime, he collects premium for selling insurance. And in total, during the financial crisis of 2008, he collected $4.9 billion of premium by selling put options on the S&P 500 index. So you're going to learn all these strategies in the program. So you don't have to be a Warren Buffett. You don't have to have billions of dollars. Even if you have got a $1,000 account or $10,000 account, you can replicate his strategies with the right options techniques. Excited right now? Okay, so with that, let's go dive in and learn about what the heck are options all about. Now, there are basically two kinds of options. On the left, you have got call options, and on the right, you've got put options. That's it, just two kinds of options. But there are a lot of fancy things you can do with them, just like a Swiss Army knife. And for each kind of option, you can either buy or sell. That's it. So you could buy a call option, which is known as going long a call, or you could sell a call option, also known as shorting a call or writing a call. And on the right, similarly, you could buy a put option, another way of saying it, going long a put, or you could sell a put option. Again, you could say shorting a put or writing a put. And that's it. All right, so what's a call option? Let me break it down for you. So an option is basically a contract. So if you buy a call option, it gives you, the buyer, the right, right? You've got the right to buy 100 shares of stock at a specific price that you lock on. And we call that the strike price. But you must do it before an expiration date. Okay, so for example, let's imagine you are bullish on Apple, and let's imagine Apple shares are now selling at $200. And you are bullish, right? You think that Apple shares are going to go up. Now, obviously, you could buy the Apple shares itself, right? But you may say, hey, I don't have the money to pay $200, right? I don't want to spend so much to buy Apple shares. Well, what you could do then is to buy a call option. You could buy an Apple 200 call. Okay, so 200 means the strike price, which is the price which you lock in. So in other words, when you buy this call option, you now have the right to buy Apple shares at $200. You have locked in the price. Okay, so if Apple goes to $300, $400, $500, guess what? You can still buy at $200 because you have locked in the price. But you must do it before an expiration date. So again, you could buy an option that expires in 30 days or 60 days or even a year. And within that time, no matter where Apple goes, you can always buy it at $200. Cool? Yeah. Now, of course, to get this right, you have to pay a price. We call that the premium. Okay? So how do you read an option? This is how you read it over here. So this is the Apple December 200 call, and it's selling at $8. So the first thing you see would be, what is the stock that's underlying the option? In this case, we are buying an option on Apple shares. Okay. The next thing you see is the date of expiration. So again, it could be January, February, March, April, in this case, December. Okay. Now, options expire on the third Friday of the month. So when you buy a December option, it will expire on the third Friday of, you got it, December, all right? The next thing you see is the strike price. The strike price is the price that you're locking in. And again, you can choose options at whatever strike price that you want. And different strike prices have different premiums, okay? And the next thing you see would be is a call. So when you think of the word call, think of the word, buying. I'm calling, right? So in this case, to buy the Apple December 200 call, it will cost you, the buyer, $8, and we call that the premium. So think about it. If you're buying this call option for $8, you want Apple shares to go up in price, right? So if Apple goes up to $250 or $300, are you happy? You're very happy. Why? Because if Apple goes to $300, you have the right to buy it at $200. So in other words, you can buy at $200 and sell it at $300 and make $100, right? And all you paid was $8 to lock in the price. That's a call option. Yeah. Now, what if you bought the call option and Apple's share price dropped from $200 to $190? Well, then you're not too happy, right? Because you have the right to buy it at 200, but it's now selling below 200. So, it's now your option becomes worthless, right? And you pay $8 for it. So at the most you pay $8. If it goes down, it's worthless. But if it goes up, my God, you can make unlimited amounts of profit. So that's how a call option works. All right, so let's take a closer look at this whole transaction. Now, you can be a call buyer or you can be a call seller. You can take either role in the market. So in this course, you'll be learning the strategies of how to profit in both roles. So again, as a call buyer, you buy the call, you pay a price, you pay the premium. In this case, it is $8, for example. Now, who collects this premium? The call seller collects the premium. But let's go back to the call buyer again. So as a call buyer, you pay the premium, and now you own the option. You own the call option. And the call option you own gives you the right. You now have the right to buy the shares, in this case it's Apple, from the call seller at the agreed upon price, which again is called the strike price of, for example, $200. Now, as a call buyer, once you own the option, what do you want? You want the share price to go up as much as possible. So as a call buyer, you are bullish. Why? The more the share price goes up, the more valuable your call options become. And you can sell your call options at a higher price than the price you bought it, right? So buy low premium, sell high premium. So how does this work? For example, if the stock price goes from $200 to $250, what does this mean? This means that as a call buyer, you have the right to buy the shares at $200 and sell it immediately in the market for $250, giving you a profit of $50. So this means your call options now have an intrinsic value of $50. And the higher the share price goes, the higher the intrinsic value of your call options. So again, for most option traders, they simply sell the call options at a higher price than the price they bought it. Buy low premium, sell high premium. Or as a call buyer, you could also exercise your options. But most people don't do that. But what does it mean? When you exercise your options, you're saying, okay, I actually want to buy the shares. So you exercise your options and you actually take delivery of the shares. You buy the shares at $200 and then you sell it immediately at $250, also making a $50 profit. So there are two ways you can profit as a call buyer. Now let's go back to the call seller. So for the call seller, how do they profit? Well, they sold the call to you, the call buyer, and they collect the premium. So for the call seller, their maximum profit they can make is the premium they receive. But by receiving this premium, the call seller is now obligated. They are obligated to sell the shares to the call buyer at the pre-agreed price, which is $200. So no matter where the share price goes, the call seller has to sell the shares at $200. So as a call seller, you are normally bearish. You believe the stock price will not go up. You believe the stock price will stay where it is or you go down. Because if the stock price doesn't go up, it goes down, what happens? The call options get worth less and less and less. And by expiration date, it becomes worthless. And that's what the call seller wants. The call seller wants to sell the call, collect the premium, and hope that the option expires worthless. Because once it's worthless, the call seller no longer has the obligation to sell the shares to the call buyer. So for example, if the share price goes from $200 to $190, what does that mean? It means for the call buyer, he has the right to buy the shares at $200. But now the shares are at $190. So the call buyer has no incentive to exercise the options, and the options are now worth hardly anything, right? So they'll say, fine, I will not do anything. And so finally the call options will expire worthless. And again, that's what the call seller wants. But again, what if the share price goes up to $250 or $300? The call buyer is happy, right? The call seller is not too happy. Because if the share price goes up again to $250 or $300, what does it mean? It means that the call seller is obligated to sell the shares at $200, but it's now at $250. If the call seller already owns the shares in their portfolio, then no worries. They just take their shares and they sell it at $200 when they could have sold it at $250. So they say, well, I could have gotten a higher price, but I have to sell it at $200, whatever, right? So it's fine. The danger happens when the call seller does not own the shares in the first place, or they have not bought reinsurance. Then they could be losing a lot of money, because as the share price goes up higher and higher, the call seller may have to physically buy the shares at a very high price at $300 and deliver the shares to the call buyer at $200. So we call that selling calls naked, right? Now don't get too excited, right? Selling calls naked means you sell a call option without first owning the shares or without buying reinsurance. And that's something you should never, ever, ever do. In this program, you're going to learn that, yes, you can make a lot of money by selling calls and collecting premiums, but you got to own the shares in the first place, or you have to buy reinsurance. So that will come in the later lesson. All right. So I hope you understand how this whole transaction now works. So how do we compare buying call options versus buying the stock itself? Let's take a look. Right. So call options allow you as a call buyer to control large amounts of stocks with a small amount of money, which is the premium, right? So again, example, Apple stock is selling at $200 right now. You expect it to increase to $220. You are bullish on the stock. So there are two things that you can do. Number one, you could buy the stock itself. So if you buy the stock, how much would it cost? Well, it'll cost you $200. And let's imagine you want to buy 100 shares. Okay, so $200 multiplied by 100 shares is $20,000. That's your investment. Okay, so it's a pretty big capital that you need in order to buy 100 shares. Now, if Apple increases to $220, the market value of your shares becomes 220 times 100, $22,000. So what's your profit? Your profit is $2,000. Got it? Okay. Now, to make the profit of $2,000, you had to invest $20,000. So what is your actual return on investment, your ROI? It's $2,000 divided by 20 grand. Your return on investment is 10%. So that's what happens when you buy the underlying stock. Now, what if you were to buy the call option instead? So instead of buying Apple shares, you buy the Apple 200 calls. So in other words, 200 is a strike price. The option locks in the price at $200 and you pay a premium of $8 for this option. So now what's your investment? Now you invest $8 because you just paid a premium, right? And multiply by 100 shares, because one contract of an option is always 100 shares. So your investment is $800 in this case, okay? So same thing, Apple price increases to $220. Are you happy? You're pretty happy, right? Why? Because you have the right to buy at 200, but now it's at 220. So what's the difference? The difference is 220 minus 200 is $20. So in other words, your options are now worth $20 in intrinsic value, okay? And $20 times 100 is $2,000. This is the value of your options, the intrinsic value. You will learn later on that it will actually be worth a bit more than that because there's some extrinsic value, but that's for later. So just for now, understand your options are worth at least $2,000. So again, you bought the options for 800 bucks. Now the options are worth 2,000 bucks. Okay, so what's your profit? Your profit would be $2,000 minus 800, giving you a profit of $1,200. So you made $1,200, but what was your investment? Your investment was only $800. So you made $1,200 out of 800 bucks, and your return on investment is 150%. So that's the great thing about buying options or buying call options, right? You get a very, very high potential return. Now, if you think that sounds too good to be true, yeah, it is too good to be true. Remember, there's always a catch. And the catch is this, that if the Apple shares do not go up by a certain amount and within a certain period of time, what happens? Your options expire worthless. That's right. So you should only buy call options if you're very bullish that the price will go up significantly in that period of time, or you will lose money on that. So in this program, you're going to learn the strategies on how to do this in a very safe way to maximize your returns with very minimal risk, and when to buy call options and when to do the opposite, which is to sell call options. Because remember, you can profit in both methods under different conditions. So let's take a look at it visually of what it's like to buy 100 Apple shares. Okay, so over here we've got a graph, and yeah, don't worry about graphs. I know we learned it in school, right? Okay, anyway, so on the y-axis we've got the profit or loss. Okay, and that's the zero line. So anything above that, it's a profit. Below that, we're making a loss. On the x-axis, we have got the share price or the stock price that increases or decreases. So if you buy Apple shares at $200, that's your break-even price, obviously. So if Apple shares remain at $200, you don't make any money, right? So your profit is zero. If Apple shares increase by $20 to $220, right? There's a $20 increase. What's your profit? Your profit is $20 per share multiplied by 100 shares. Your profit is $2,000. So that goes up. Ta-da! You make $2,000. If Apple falls by $20, right, drops in price to $180, you lose $20 per share. Multiply by 100 shares, ta-da, you lose $2,000, right? So you can see that when you buy shares, it's a one-to-one profit and loss. Share price goes up by $1, you make $1. Share price goes down by $1, you lose $1. So the graph is a straight line all the way up. Now what happens if Apple from $200 drops to zero? Now of course it's very, very, very unlikely, but if it happens, if Apple goes bankrupt, how much do you lose? You lose the maximum of $200 per share times 100, 20 grand gone. Of course, unlikely to happen, right? But again, if Apple goes up to goes up to $500, what happens? Then again, you make a lot of money. If Apple goes up to $1,000, right, you make a lot of money. So you can see when you buy the shares, you have got unlimited return, and well, yeah, the risk is limited to your total investment. So you can lose everything, right? So that's how you buy the shares. Now let's compare that to buying a call option, and let's look at the difference. All right, so let's take a look now at the profit and risk profile of buying a call option instead. So notice at first glance, what you notice? That it's no longer a straight line, right? Like the shares was a straight line. Now what happens is your downside is kind of like limited. Okay, why? So again, in this scenario, we are buying one contract. Again, one contract is always 100 shares. You're buying one contract of Apple calls with a strike price of $200. We are paying the premium of $8. So in this case, what's our maximum risk in buying the call option? Our maximum risk is the premium that we pay, which is $8. So $8 multiplied by 100 shares, because again, one contract is always 100 shares. So $8 multiplied by 100 shares is $800. So the maximum risk is $800. Hence, the downside is limited to $800. That is the worst that can happen. In other words, if Apple's stock price from $200 falls to zero, the most I can lose is $800. So that's the great thing about buying a call option. You cap your downside. Now, what if the price goes up, which is what we want? So for example, if Apple shares go up to $220, again, remember the x-axis tells you the stock price and the y-axis tells you the profit and loss, right? So again, right now Apple is selling at $200. We are buying the option with a strike price of $200. If Apple goes from 200 to 220, are we happy? Yes. Why? Because again, we have the right to buy it at 200, but now it's selling at 220. So we could buy it at 200 and sell it at 220, giving us an intrinsic value of $20 per option that we hold. All right. So the profit at expiration, as you can see over here, would be the stock price minus the strike price. So if the stock price becomes 220 minus the strike price of 200, that's $20. So again, our options have a $20 intrinsic value. But again, we paid $8 for it. So we have to deduct the cost of buying the option. So we have to minus $8, which is the premium. Okay, so that gives us $12. So $12 multiplied by 100 shares is $1,200, which is our net profit. So in other words, if Apple goes to 220, you can see we make a profit of $1,200. There we go. That is our minimum profit that we make at expiration. In fact, we could make more than that if we sell it before expiration, but more on that later on. Okay. Now, what's our break-even price? Our break-even price is equal to the strike price plus the premium. Okay. So in other words, in order to break even, the share price has to move at least the premium that we paid. So in this case, the strike price is $200. The premium is $8. So the break-even price is $208. There we go. So if the share price doesn't move to 208 or more, we will lose money. And the max we can lose is $800. But once it crosses 208, the sky's the limit. So you can see again from this chart that by buying a call option, we've got limited risk, but unlimited returns. Now, but what about the call seller? Remember that you can either be a call buyer or call seller. And for the call seller, it's the complete opposite. The graph looks like that. Ta-da! Oops, hold on. The graph looks like that, right? It's inverted. So remember that for the call seller, it's the opposite. You have limited return, but potentially unlimited risk if you sell the calls naked. Now, I'll explain what that means in a short while. Don't get too excited, all right? So again, when you sell the call, what happens? As a call seller, you get a premium, right? So the maximum profit you get is the premium that you are paid. So in this case, $8 times 100 is $800. So in this case, your profit, which again is above the zero line, is limited to the premium that you collected. All right. And again, when you sell the call, you want the price to remain where it is or go down. So again, notice that when the stock price goes down, right, you get the maximum profit, which is the premium you collect. But if the price goes up, then you may not be that happy, right? Because if the price goes up from $200 to say $220, what does it mean? Remember, as a call seller, you are obligated. You have the obligation to sell the shares at $200. So if the share price goes up to $220, what does it mean? It means you have to buy the shares at $220 and sell it at $200, making a $20 loss. If the shares go up to $300, then you have to buy it at $300 and deliver it to the call buyer at $200, making a $100 loss. So the higher it goes, the worse it is, because you have to buy at a high price because you're obligated to sell it at $200, right? So what is the potential loss? The potential loss is unlimited, because if the price keeps going up, you have to buy at a very high price to deliver it to the call buyer. So the potential loss equals to the strike price minus the stock price plus the premium that you collect, right? So for example, if the share price goes to 220 in this case, and the strike price is 200, what's the difference? The difference is 200 minus 220 is $20, right? So minus $20, you lose. But you collect the premium of $8 plus $8. So net, you lose $12 times 100 shares, you lose $1,200. So when the share price goes to 220, you potentially lose $1,200. Okay? Now, what's your break even for this trade? The break even price would be the strike price plus the premium. Okay, which in this case is $200 the strike price plus the premium 208, which is over here. That's the premium. So in other words, as long as the stock price remains at 208 or lower, you are profitable, right? If it goes above that, then you're making a loss. Now, some people wonder, then in that case, why would you want to be a call seller? Because there's unlimited loss, there's limited profit, right? Absolutely. And that is why you never ever sell calls naked. Again, don't get too excited. What do you mean by selling calls naked? Which means to say you just sell a call option without owning the shares. Then you've got unlimited loss. But if you already own Apple shares, you already have Apple shares in your portfolio, and you sell Apple calls, then that's fine, right? Then actually there's a no risk situation, right? And we call this selling covered calls. And you will learn this as part of the lesson in the curriculum, right? So again, more on that later on, but do understand that yes, you can sell calls, but you have to own the shares first. Because if you already own Apple shares, then it's fine, right? Because if you own Apple shares and the share price goes up, you don't lose money because you already have the share. So you just deliver it to the call buyer at $200. You just cap your potential profit on your share portfolio. Okay, great. So to summarize, call options. All right. So again, for call options, you can buy a call or you could sell a call. All right. And when do you buy a call? You buy a call when you are bullish, when you expect the price to go up, and you profit when the price goes up. As a call buyer, you have the right to buy the shares at the strike price. And your profit graph looks like that. Limited risk, unlimited return. Okay? As a call seller, it's the opposite. As a call seller, you are obligated to sell the shares at the strike price. Okay, so you want to sell calls when you are bearish, when you think the price would go sideways or go down. And your profit graph looks like that. Limited profit, but unlimited loss if you don't own the shares, if you sell naked. But again, if you own the shares, that's fine. If you own the shares, limited profit, no loss. All right, so it's a no risk scenario, and we call that selling calls that are covered by shares. Selling covered calls is a very powerful strategy used by stock investors. You will learn that in future lessons.